Instruments and Tools of Monetary Policy. This is Chapter 18. So what we'll do is now we'll understand, after having understood the way the Fed and FOMC functions, we're going to study the tools of monetary policy, how the monetary policy mechanism percolates into the economy. So the variable that is controlled by the Fed and linked to the monetary base, M1 or M2 and interest rates, is called a tool of a monetary policy. And this can be achieved through either open market operations or discount window, or by setting the reserve ratio requirements of commercial banks. So let's talk about open market operations first. In open market operations, the Federal Reserve, essentially the Federal Reserve District Bank of New York, purchases or sells government securities, G-SECs, and government agency bonds. For example, purchase of securities by the Fed from a broker leads to creating a new deposit for the broker in a bank account. That deposit creates a chain reaction of loans and deposits, as we've seen before, and therefore this is called as infusion of liquidity. Now there's a multiplier effect of this on deposits, and we're going to study that. This multiplier effect is actually linked with the reserve ratio that commercial banks must maintain within their accounts. So the multiplier effect is as follows. Let's assume that Fed has $200 million of securities, and the broker banks has $200 million of deposit as a result of the transaction that took place. So Fed did an open market operation purchase of securities from the broker. So what happens is, in the next step, the broker's bank now has excess reserve of $200 million and an extra deposit of $200 million. So because of this purchase operation, the broker's bank now has $200 million to give out as loans from these deposits. Now, it's not, currently the reserve ratio is 0%, but it's not necessary. If the reserve ratio goes up, then the bank cannot loan all of that increase in reserve to customers. It can only give out a fraction of that in customers. So let's assume that the required reserve ratio is 10%, which means that the bank has to keep $20 million in reserves, and the remaining $180 million can be loaned out. So the bank's balance sheet now looks like $20 million in reserves, $180 million in loans, and that new deposit of $200 million. Now notice, we've assumed that the bank is doing the best it can to attain the maximum possible productivity through giving out loans. Now that might not always be feasible or possible in a real-world scenario. So we have to take that with a grain of salt. Now what happens is, because this loan was created, essentially funds worth $180 million were given to another party by Bank 1. So this loan now becomes a deposit with Bank 2. And the Bank 2 now has $180 million worth of deposit, which increases its reserves by $180 million. Now, since the required reserve ratio is 10% or 18 million, Bank 2 will keep the 18 million and loan out the remaining 162. So 118 minus 18 is 162. So the new deposits in Bank 2 are 180, but it has given out a new loan or created a new deposit of 162 million. And this process continues indefinitely. At the limit, the sum total of all this is a geometric progression with a common ratio of 0.9. And so we can easily sum it up as an infinite geometric progression because the common ratio is less than 1. And so it's basically 200 divided by 0.1 or 2000 million. So the total, this is called a multiplier effect. The multiplier effect of all the deposits that are created by this infusion of liquidity is not 200 but 10 times, or 1 over the required reserve ratio times the initial purchase amount. So the Fed purchased 2,000, and therefore there's an infusion of liquidity 10 times that. So the Fed infused a liquidity of 200 million, and the total liquidity that was actually infused because of that was $2 billion. Okay, so when money supply increases, bonds prices rise and interest rates fall. So people have more money in their bank accounts as a result of this chain reaction, and they have to invest that money. So they start buying bonds. And when bond prices rise, interest rates are inversely proportional. So interest rates will fall. Now, open market operation has its own drawbacks. For example, open market operations can only affect the shorter end of the yield curve. And its main advantage is precision. We know exactly how much money can be infused and is going to be percolating through the economy. It's flexible. The Fed can backtrack or even reverse course. So for example, suddenly in the morning, the Fed is doing open market purchases and realizes that, oh boy, we need to dry out the liquidity. It can do open market sales. The disadvantages are it's not a very clear sign. So the Fed can keep on doing open market purchases and sales in the background. People will know it, but are not cognizant of that as strongly as a discount window or a required reserve ratio change created by the Fed. So there are two types of market operations, defensive and dynamic. And a defensive market operation is essentially when there's a crisis or a bank run or something like that, the Fed is trying to infuse liquidity to save banks. And dynamic is one in which Fed is actually creating a monetary policy repercussion as a result of either purchase or sale of bonds. For example, to fight inflation, the Fed will try to dry out all the liquidity possible, as is happening in 2024 and 2023. And therefore, dynamic market operations are pretty explicit, pretty clear, and the market knows which direction the Fed is going. So now let's talk about repos and reverse repos. A repo is essentially an action by a bank in which the bank is selling securities to repurchase it tomorrow. So when I sell securities, I will get money. So banks will get money from the Fed, and because it's a repo, means the bank has to repurchase the bonds back from the Fed, it will have to buy those bonds back at a fixed higher price than the price at which it sold it to the Fed. Essentially, that's how it becomes a borrowing. Get a lower amount and repay a higher amount. So in this case, in the case of a repo, only thing is it has a security that is backing it. And usually these securities that are utilized in repos is a government bond. Reverse repo essentially is the exact opposite. So in our case, for example, when the bank was doing the repo, the Fed was doing the reverse repo. In other words, the Fed was selling securities today in order to buy them back, repurchase. The Fed was buying securities today in order to sell them back or reverse purchase them at a later date. So here in this case, the Fed is the lender. It buys the securities and then it takes the money back after a certain time. The next tool of monetary policy is a discount window. In a discount window, the Fed directly lends money to a depository institution at a given rate. And so it's a very direct method. There are three classes of credit in terms of who is borrowing from the Fed. The first is the primary or discount rate. It is a Fed funds rate plus 100 basis points. And this is a rate that is reserved for good banks that are credit worthy and maintain a very good balance sheet. The secondary discount window, secondary rate is a little bit higher, and this is a rate that is given to troubled banks. And the last one is these seasonal banks in which banks face fluctuations due to changing seasons, change in demand and supply of those loans. And for example, an agriculture bank will get a lot of liquidity when farmers are harvesting their crop. So when it's the exact opposite, in that case, these banks will need funds from the Federal Reserve. So that is when they will borrow money through the discount window from the Federal Reserve. So these are seasonal banks requiring seasonal credit. Bottom line is the discount window is utilized by banks to manage their day-to-day liquidity. And so the discount rate is usually greater than the Fed funds rate. That's because the Fed is trying to signal to the banks that this is a right but not a privilege. In other words, that the Fed can lend the money to the banks, but definitely not at the privilege of those banks. And this is called a Lombard system. The reserve ratio is the most potent of all the tools. It is direct. It affects banks in real time. And for example, in 1980s, the Fed's decision to increase a reserve requirement actually had a negative impact on the loan creation process. Currently, the required reserve ratio is 0 in 2024. And the way required reserve ratio works is that the Fed will not track every bank's deposit every day, or every bank's reserves every day for that matter, which are linked to the deposits. So for example, a bank has $100 of deposit. The required reserve ratio is 10%. So the bank must keep 10% of its funds as reserves. And that is also why, so some countries, the Fed will mandate the banks to put cash in its own accounts at the Federal Reserve. In some countries, they say, no problem, you can keep the required reserves in terms of government bonds. So the banks invariably have a bond trading desk for this reason. And so instead of measuring it every day, the Fed actually measures it every 14 days, and typically it's a Wednesday. And the Fed allows banks to carry a surplus or deficit of 2%, which has to be made up in the next cycle of 14 days. And there is a trader that actually manages the reserves of a bank with the Fed, and they have a fun job. Otherwise, if it follows above or beyond 2%, then the bank gets into trouble just because the trader did not do their job well. On the other hand, the trader does the job well and then keeps the liquidity exactly as required with the Fed, nobody notices. The economic effects of required reserve ratio are beyond the scope of the class, but a flavor of that can be seen in the loan creation and deposit multiplier process. So remember, the total infusion of cash is the initial infusion or the open market purchases divided by the required reserve ratio. So the required reserve ratio is higher, if the required reserve ratio is higher, the exact amount of multiplier effect will be lower, which means that the entire amount that the Fed really wanted to percolate through the economy is not really happening unless the required reserve ratio goes down. As of 2024, the required reserve ratio is 0% and has come down because of the COVID crisis. Required reserve ratio has certain advantages, like it's fast, and its disadvantages because it's fast, it's also too blunt. It materially impacts banks in real time. And it's also not very flexible. It's just a blanket mandate from the Fed, which the banks must follow. So it's a blunt signal from the Fed. Now let's move on to how the monetary policy is conducted, particularly by the New York Federal Reserve District Bank. So the Fed actually has a lot of objectives: stable prices, low unemployment, long-term growth, stable currency, stable financial markets. All of these are very important. In the case of stable prices, the Fed must maintain stable inflation. The price of a commodity increases, then either the demand for that commodity was up or supply was down. And then, based on this, consumers adjust their consumption pattern, and therefore they start demanding more wages if there's inflation in the economy, because the purchasing power is lost because of high prices and same income. So this is how inflation has looked like since the 1980s. So the oil price shock had an effect on the US economy and the inflation, but because of tightness of monetary policy of the Fed, the inflation rate came down. Between the 1990s, that is 1992 to 1999 maybe, the inflation was relatively more stable, and then it started climbing back up steadily until the big financial crisis happened. Again it crashed, and then again started slowly making upward progress again until the COVID pandemic time. So that's when it spiked again. Alright, how is unemployment method measured? Unemployment is a tricky term, let's say, in economics, and the most explicit way unemployment can be measured is by taking a survey. So the BLS, the Bureau of Labor Statistics, calls up a lot of people every month and asks them if they were looking for a job. If they did not have a job, were they looking for one actively? And then if they did, but still could not find a job, then they are defined as unemployed. So unemployment is bad, but it's also inversely proportional to GDP, and that is Okun's law. So the percentage difference of GDP from its potential when the employment is fully employed, when the labor force is fully employed, as a percentage of the actual GDP is essentially a function of the difference of natural unemployment and the actual unemployment. Natural rate of unemployment is that rate of unemployment which corresponds to the potential GDP. The Fed is also involved in monitoring the long-term economic growth of a country, and it also tries to stabilize the dollar when there is a fluctuation in dollar in the international currency market. So sometimes the Swiss franc becomes strong, sometimes the Japanese yen becomes weak, like it just did in the recent times in 2024, and so volatile dollar is not preferred by customers, and therefore the Federal Reserve tries to go against the market to try to stabilize the price of dollar. And then the Fed is also required to stabilize financial markets. In 2008 recession, the Fed, although it was slow to rise up to the occasion, it did ultimately buy securities of all kinds from banks to keep them liquid and afloat. In March 2022, it is pretty well known how the Fed was saving or rescuing the markets. It cut the interest rates by 50 basis points, and then most of its staff were working from home. And the most curious part that they remember in their recollection is that they bought 1 month of government securities in a single day to provide liquidity, open market operations to the market and stabilize the market. Now, these are the short-term tools. Now let's look at the policy targets. So a good target variable must be measurable. Otherwise, if you cannot measure it, how do we know if it's changed or become better? It should be controllable. If you cannot control it, then there's no point in using it to control something, right? Quote unquote. And then it should be important. It should be strongly correlated with the real level of economic activity within the country. So these are the three important characteristics of intermediate monetary policy targets. Now, net free reserves is essentially excess reserves minus the borrowed reserves. So in the 50s and 60s, essentially let's look at net free reserves as extra cash lying in a bank. In the 50s and 60s, the Fed tried to do this by open market operations. So if the banks had too much money, the Fed would probably do a sale and take the money away from these commercial banks. So the NFR is a problematic thing because it keeps fluctuating when the Fed does not do anything either. And so controllability and measurability are two important factors of a good determinant of monetary policy. So in recession, there is a lower demand for loans, and therefore the interest rate is low. However, the net free reserves are high because nobody is taking a loan. So banks have extra assets in the form of liquidity. So what the Fed wants to do really is to dry off that liquidity, or dry off all those new deposits that are existing in the market. To do this, the Fed does open market operation sales of government bonds, which when you sell something, its price goes down and its yield goes up. And that's what happened in a recession. But this is a problem. Instead of higher interest rate, we want a lower interest rate, because the lower the interest rate is, the more stimulated the economy gets because they can borrow money through a loan. Now this is how the Fed, who's on the top, controls the economy, which is at the bottom. So the Fed controls a bunch of dollar-valued accounts, such as bank's reserve, monetary base, which is larger than the bank reserve, non-borrowed reserves, non-borrowed base, discounts, and net free reserves, which are available for lending. And then on the right, the Fed funds rate, the treasury bill rate, and the commercial paper rate are some money market yields, short-term in nature, directly controlled by the Federal Reserve. So the tools of monetary policy of the Fed are open market operations, the discount window, and how much reserves banks must maintain. So we've seen the short-term measures. Now let's look at the long-term measures. In the long run, we measure money supply through M1. Or we also measure money supply through bank credit. All those deposits that flew in the bank thanks to one operation by the Fed, those are also tracked. But the problem sadly is that these tools of monetary policy do not contain, for example, a 30-year government bond yield, or a 30-year corporate bond yield, or a 30-year municipal bond yield, or even the mortgage rates. Remember, mortgage rates are controlled by banks themselves, thanks to one of the acts that we've studied in this course policy. And then, so the final goal of Federal Reserve essentially becomes stable price, high employment, stability of foreign currency in terms of dollar, giving long-term growth and stable financial markets. Alright, now let's look at some of the historical actions of Fed. We already saw how NFR was tried to be controlled by the Fed, but didn't really work out. NFR is net free reserves. Between the period 42 to 51, the United States was at war. And so the Fed wanted to stabilize the interest rates. And so the Fed actually, in order to stabilize the interest rates, bought government securities, dried up the liquidity, led to higher interest rates. And the government on its front also curbed wages and prices, so had a price cap till 1950. Excuse me. Later, inflation rose, but the government was also forced the Federal Reserve to keep stabilizing the interest rates until 1951. But what was happening was the government was selling bonds and was making the Federal Reserve keep buying them. So it was funding itself indirectly. In 1951 or 50 onwards, the Fed tried to control net free reserves, or NFR. Now when net free reserves are controlled, interest rates obviously will fluctuate. So if GDP goes up, investment goes up, and if more companies are trying to create plant and machine, interest rates will go up. And if interest rates go up, then net free reserves will also fall, because net free reserves are essentially those amounts which have not been borrowed for loan. So if the investment has gone up, they must have taken a loan and therefore led to a decrease in net free reserves. So then the Fed does open market operation purchase and gives money in the hands of people. So that's what the Fed did. But when they gave money to people, the people started buying a lot of bonds. When people started buying a lot of bonds, its price went up and the interest rate went down. But wait, we're targeting net free reserves, right? So this is a contradiction, because it leads to greater inflation. Moving on to the 70s, Fed funds was a short-term target, and in the medium run, the Fed actually wanted to track its money supplies M1 and M2. If both interest rates and market share actually go up, the Fed will target interest rates. This led in the 70s to increased money supply and higher inflation expectations, because interest rates are going up, money supply is going up, people have more purchasing power and start buying goods and services, driving the prices higher. Between 79 and 82, the Fed actually woke up and started targeting inflation instead of net free reserves. So inflation was targeted broad range through the Fed funds rate, narrow range through the MS target, money supply target, and another target was non-borrowed resources. In this period, the inflation rate started out at 12%. But since the Fed funds rate were higher for an extended period of time, inflation started coming down. By the time we reached the period 82 to 90, inflation had now decreased to 4%. And so the Fed actually now goes back to interest rate targeting. It also gave out discount loans to cover operating target. The link between M1, M2 and GDP broke down with the evolution of new markets and instruments. And the biggest change that was happening in the late 90s, early to late 90s, was everything was going online to computers. So between the 90s and 2000s saw a very stable period of growth, and the Fed actually reverted to Fed funds targeting. Because the economy was in the Goldilocks situation, not only there was no inflation, but there was also a booming GDP. So in 2000, 2001 and current recession, the Fed tried to keep its interest rates low. In March of 2020, the Fed actually came in through on March 12th particularly with a 50 basis point cut immediately, and also infused a lot of liquidity through open market purchases and sales, primarily purchases from retail customers. A combination of loose monetary policy and accommodative fiscal policy actually led to an increase in interest rates. And much later interest rates, but more importantly, inflation that is immediate. So to control this inflation, the Fed again had to increase its interest rates. That's what we are seeing between the period 2022 and 2024. And that's chapter 18 and 19. Thank you very much for listening.